Okay, let's unpack this. Today, we are undertaking a deep dive into the massive and, well, rapidly changing banks' diversified sector. Our mission is really to cut through the noise. We want to deliver a detailed journalistic report on the three titans, the ones anchoring the U.S. financial system. We're talking JPMorgan Chase & Co., Bank of America Core, and Citigroup, Inc.
And these aren't just big banks, right? They are essentially global financial infrastructure. When you consider the scale, I mean, JPMorgan Chase's market cap soaring over $867 billion. Well, the sheer magnitude of their performance, it just ripples through the entire economy. So yeah, we're looking at JPM, BAC, and C3 giants, and they're all facing this synchronized structural shift. Technology is a big driver there.
Right. And before we start crunching these numbers, these are closing numbers from September 30th, we absolutely have to state the crucial context up front.
Absolutely, yes. It's really important. The data we're analyzing here, it's purely sourced from public stock screening and market reports. It's for informational and educational purposes only. We're just focused on understanding the metrics, the trends, what the data tells us. This analysis is not in any way, shape, or form investment advice, okay? It's simply a tool for you, the listener, to become better informed.
Sound analysis needs sound data. Let's start then with, well, the undisputed heavyweight champion, you could say, in terms of size, brand equity, profitability, JPMorgan Chase & Co., JPM.
Okay, JPM. It closed just over $315. And when we scan the valuation metrics, it immediately tells you the market puts a massive premium on this stock. The price-to-earnings ratio, the PE, it's the highest of the three we're looking at today at 16.1. But what really jumps out, I think, is the price-book ratio, the PB. That sits at a pretty elevated 2.57.
2.57.
Yeah.
So just to clarify for everyone, that PD, that's crucial, isn't it? It basically means investors are willing to pay $2.57 for every single dollar of the bank's actual book value, its assets minus liabilities.
Precisely. Yeah, that suggests, well, overwhelming confidence. Confidence in JPM's management, its brand, its future earnings power. And this confidence, it seems supported by financial metrics that are, frankly, best in class. Return on equity, ROE, very high at 16.13%, and their profit margin is just shy of 20%. Really strong numbers.
But, okay, if the market is that confident, is there still, room to run? We see the PEG ratio is quite high, 2.39.
That's where maybe a bit of caution comes in. The PEG ratio, it factors in expected growth, right? So a high figure like 2.39 implies that JPM's excellent expected growth EPS next 5 years, estimated at about 6.76%, might already be fully, maybe even richly priced into the stock.
And here's an interesting tension I see. While institutions hold a massive chunk, 74% of the shares, insider transactions recently showed significant net sales, almost 2.7% negative. So if the growth is maybe fully priced in, is the smart money perhaps taking some profits off the table right now?
That's a really valid question. And the technical picture suggests the stock is definitely, well, running hot. JPM has been an absolute powerhouse, up over 50% in the last year alone, and 28.59% just over the last 6 months. That kind of momentum has pushed its relative strength index, the RSI 14, up to 68.54.
68.54. So that RSI tells us JPM is knocking right on the door of that typical overbought territory, usually around 70. It suggests that while the long-term uptrend is incredibly strong, I mean, the stock is way above its 200-day moving average, it might be due for a temporary breather, or maybe encounter some resistance as it gets near its 52-week high. And you should also note that high average true range, $5.08, that signals pretty significant daily price swings, volatility.
And looking at the recent news, JPM certainly isn't, resting on its laurels. We see a heavy focus on digital, launching new AI tools, and a very forward-looking move, filing plans to put private credit assets into an ETF wrapper. That shows they're consistently adapting, looking for new products, new demands.
Okay, and that 28.59% six-month return, that gives us our first glimpse at performance in our paper money scenario. Just for context, if you had hypothetically invested $10,000 in JPM 6 months ago, well, that strong performance would have translated into an estimated paper profit of around $2,860.
Yeah.
A pretty solid return, definitely reflecting its market leadership.
Right. So if JPM is the expensive blue chip leader demanding that premium, let's look at Bank of America next. BAC offers a slightly different profile, maybe one where the growth story looks, let's say, far more efficiently priced.
Bank of America, ticker BAC. It closed just over $51. And right away, its PE of 15.11 and PB of 1.39 show a much more Well, reasonable valuation compared to JPM.
Exactly. And that efficiency, it truly shines when you look at the PEG ratio. It's sitting right at 1.01, which is, essentially the textbook definition of fairly priced growth. The market expects BAC to grow, seems like, and the current price reflects that expectation without, excessive optimism built in. And analysts certainly seem to agree. They give it a better consensus recommendation of 1.68 than JPM, with a target price hovering around $55.
And their financial health, it shows stability. Return on equity is 9.46%, profit margin 13.4%. Okay, so not quite matching JPM's top-tier efficiency numbers. But BAC is projecting some impressive forward growth. EPS is expected to surge 16.20% next year and maintain a strong 14.90% over the next 5 years. That's pretty robust.
That is a strong, steady growth forecast, yeah.
Technically speaking, BAC is also enjoying a strong uptrend. It's up 30.54% over the last year and 23.63% over the last 6 months. Solid performance.
And what's interesting about BAC's momentum indicators compared to JPM is that they are more in that neutral zone. Its RSI is 58.82, so strong but not looking overheated. It suggests maybe more room before it hits typical resistance levels. The stock is comfortably trading above all its key moving averages, which confirms that strong long-term trend, though it is currently quite close, only up 2.44% away from its 52-week high. So that's something to watch. And the news flow for BAC, it highlights both sort of corporate responsibility and digital innovation. They recently fulfilled their commitment to raise the minimum hourly wage to $25. That reinforces their social standing. And on the tech front, they too are leveraging AI quite heavily, using it to deliver faster advice. And they unveiled a specific AI-driven capital markets insights tool. So it's clear the focus is on integrating technology, improving both internal and client-facing processes.
Right. So stability and that efficient pricing seem to have delivered strong results. That 23.63% half-year performance means that our hypothetical $10,000 investment 6 months ago would have yielded an estimated paper profit of about $2,363. Very respectable results.
Yeah.
For a stable blue chip like BAC.
Very respectable indeed. Let's turn our attention to, well, maybe the potential turnaround story here. Citigroup C. If JPM is the premium you pay for quality and BAC is maybe the value play, C presents perhaps a higher risk, higher reward kind of opportunity, and it seems rooted entirely in a major restructuring effort.
Citigroup, ticker C, closed just over 101.1. And this is where the valuation data gets really fascinating, I think. Their PE is 15.01, actually quite similar to BAC. But that PEG ratio, 0.58, that's remarkably low.
Yeah, 0.58. A PEG ratio well below 1.0 like that is often seen as a strong signal. It suggests the market may not be fully appreciating the bank's projected earnings power. And that potential undervaluation, it's most starkly confirmed by the PB ratio. Citigroup is trading at 0.95.
Hold on, 0.95. So Citi is the only one of these three we've looked at that is currently trading below its accounting book value. That's what PB 0.95 means, right? Kind of implies potential bargain status.
That's absolutely the aha moment here, yes. The stock is essentially priced below the value of its assets on the books, which is pretty rare for a major U.S. bank. However, we have to look at the other side of the coin. Their profitability metrics are much lower. ROE is only 6.64%, profit margin 7.62%. That's lagging significantly behind both JPM and BAC.
But isn't that low profitability kind of a massive red flag? Doesn't that outweigh the bargain PB? Why would the market be willing to give them such a pass on those numbers?
Well, the market's often betting on the future, right? Not just the past performance. Despite those lower current figures, the ongoing restructuring seems to be fueling projections of explosive growth. Analysts estimate EPS growth over the next 5 years at a massive 25.72%, and EPS growth this year is projected near 28%. So that very high expected growth seems to be compensating, in the market's view, for the lower current operational efficiency.
And the technical performance certainly confirms the market is already rewarding this restructuring. Citigroup has delivered the most explosive recent performance of the three by far, up a stunning 64.48% over the last year, and a massive 42.98% over just the last 6 months alone.
42.98% in 6 months. That's incredible, really. And like the others, the price is comfortably above its key moving averages. The RSI is at a strong but not overheated 58.90. It really looks like a recovery stock that has clearly broken out and is, well, currently rewarding patient investors quite handsomely.
Yeah, and the news definitely backs up this strategic overhaul narrative. Citi recently sold a large stake in Banamex for about $2.3 billion. That was seen as a key step in simplifying its, frankly, quite complex structure.
But the real insight into their strategy, perhaps, lies in their forward-looking statements. Citi is heavily involved in blockchain and technology. They're not just mandating AI training for employees, which is interesting in itself, but they issued a really bold forecast. They project the stablecoin market alone could reach $4 trillion by 2030. $4 trillion. That kind of projection signals where they believe the massive new revenue streams are going to be generated in the coming decade.
Wow. That focus on radical future growth certainly explains why some prominent commentators are calling C the cheapest of the big banks.
Yeah.
Okay, let's look at the result of that performance with our paper money. That phenomenal 42.98% half-year growth means a $10,000 investment 6 months ago would have yielded the highest estimated paper profit of the three we looked at today, about $4,298.
Yeah, that number clearly showcases the dramatic turnaround story, or at least the market's perception of one, currently underway at Citigroup. Hashtag tag outro.
So when we synthesize all this data, we see three giants, yes, operating in the same sector, but offering wildly different risk-reward profiles for you to consider.
Yeah.
JPM is the expensive, highly profitable leader. Its high valuation metrics suggest much of the growth might already be priced in.
Then you have BAC, offering stability, strong analyst support, and that efficient valuation. The expected growth seems reasonably priced against the current stock. It's sort of the stable operator of the group.
And then there is Citigroup, the clear, high-momentum turnaround story. It's the only one trading below book value, that PB of 0.95, and it delivered that massive 42.98% gain in just 6 months, backed by the highest projected long-term EPS growth.
What connects all three, though, I think, is the aggressive embrace of technology. It's a common thread, whether it's JPM's new ETF focus, BAC's AI integration, or Citi's explicit forecast for the stablecoin market. These institutions clearly recognize that the structural shift away from purely traditional banking is happening right now. The sector is evolving rapidly, perhaps beyond what traditional valuation metrics alone can fully capture.
And that leads us perfectly into the final provocative thought for you to maybe explore on your own. Citigroup is projecting a potential $4 trillion stablecoin market by 2030. $4 trillion. If Citi is really banking on that projection, what does this massive strategic pivot into digital assets imply? What does it mean for the future revenue streams of traditional banks? And, crucially, does anticipating that potentially immense market shift justify Citigroup's currently low price-to-book ratio? That's definitely a question worth mulling over.